Hello, traders. Gary Wagner here. Approximately 1:15 in Honolulu, 7:15 in New York on Tuesday, the 28th day of September 2021, and this is the daily report for gold and silver. A higher U.S. dollar and higher yields in U.S. debt instruments set off a sell-off in gold, silver, and U.S. equities today, all of them tumbling to lower pricing. In the case of gold and silver, a decline of 1% plus in both precious metals. We'll talk about that as we look at some charts and discuss what we see as the upcoming possibility for lower pricing now that that key level has been breached. Gold continues its steep decline, giving up $18.10, and the December contract breaking below a key level of support at $17.38. Currently, we have December futures fixed at $1,733.90. This is a combination of dollar strength as well as higher yields in Treasury notes. Treasury notes have gone to a 3-month high, and the dollar index has currently traded to the highest closing price of the year, 93.75, after increasing by 0.4% today in trading. As we have been speaking about, over the last couple of weeks, we identified a key and critical technical support level that's based on a Fibonacci harmonics from an extremely long-term data set and an extremely short-term data set. The short-term data set is showing that 1738, 1737 is the 61.8% Fibonacci retracement from the low of the flash crash 1677 up until these highs achieved at the beginning of September at 1836. That's a key level that it broke. It is more than a normal retracement. It also matches up quite eloquently with a very, very long-term data set, which is indicating a 38.2% Fibonacci retracement occurs roughly at the same price point. And to put the long-term data set into perspective, we had to compress our daily chart into a weekly chart. And what you're looking at is a period of time beginning in September of 2018, when gold was trading as low as $1,167 up to the record high that occurred in August of last year at $2,088. And when you look at the current retracement, it is indicating a 38.2% retracement at this particular price point, 1738. We obviously have breached it. We are trading overseas, and gold is currently trading roughly at 1734. If we see gold continue to trade below this particular price point for more than a couple of days, indicating that that has now become a resistance area, our next real target has got to be $1,677. First of all, it is the low of the flash crash, so it's the beginning of the short-term Fibonacci data set. It also corresponds, if you look at these lows that occurred really in the first couple of months, this is that double bottom that occurred in March, right here on a weekly chart. And we can even extend this a little bit further and see a series of lows that came in during the June of last year. You can see that cluster of lows right here. So we have significant historical data that shows this low as being a potential for the first major support area. Below that would come 1628. That is based upon the 50% retracement level of this long data set. However, in terms of a price point, that is over $100 away. I believe if we see gold continue to drop in price based on the historical data, in other words, points in which it has found support at 1675 to 1677, if we see a continuation of gold dropping, we could find gold breaking through 1700 and trading as low as 1675. With that in mind, we are currently flat with no active trades. However, if we see gold maintain a price point below 1737, 1738, that to me would signal a short sell in gold. While this would be a speculative trade for some of our subscribers, we recognize that many of our subscribers have physical gold positions that they have been accumulating, and you would think of this as a way to hedge further decline in gold pricing rather than a speculative play. We're looking at a daily dollar index chart. And what is significant to me is you can see the lows that came in the dollar index really occurred at the beginning of this year. We had a couple of apexes. We had this high that occurred in April. Then we had this record top for the year that occurred at the middle to third week of August. Now, today's close is the highest closing price this year. No doubt about that. It's the highest intraday price we have seen this year. And the close, interestingly enough, corresponds to the last intraday high. And we can see that as we connect the dots, so to speak, by drawing a line across this. So a break above this puts us in new territory for the dollar index this year. And that is one of the primary factors, that and higher yields, that have been pressuring gold to lower pricing. In terms of a percentage drawdown, silver also incurred a 1% plus decline today in trading, 22.46 cents after factoring in today's 23-cent decline. However, it is the low that is really important to us. That is 22.08 and matches up with some recent lows that we have seen earlier this month. Silver also sustained a drawdown today of just over 1%. However, what was most interesting in silver today is this low. Although it's a little bit higher than the lows we saw earlier in September, it is coming in this area, and we can definitely see on a short-term basis support came in. The silver market has an industrial component, but the weakness we saw today was watching the tech stocks, companies that are heavy utilizers of silver as a primary product, such as the production of solar panels. That took silver lower, and we found support coming in at just above $22 per ounce. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.